Hi everybody, hugely important video this one, can't wait to deliver it. A video on UK economy stats, a video on how the UK economy is performing. You know, examiners expect you to have this knowledge and then to use this knowledge in your macro essays. So your job is to make sure you watch the entire video all the way to the end. You write down everything that's being covered in the video and then you use this in your macro essays and watch your marks increase because of it as you weigh up your analysis and you weigh up your evaluation. Also guys, please share this video with everybody. Economic students, yes, but also just general people who are interested in how the UK might be doing. The more people that have knowledge of the UK economy, the better. And also know that this is one video in my revision for 2025 exams playlist. There are plenty more in there already. There are lots more to come as well. Those videos are geared towards helping you revise to the highest level and then hit the best grades in your final exam. So great that you're watching this one. Watch all the others in there and make sure you're subscribed to the channel so that you know when new ones are uploaded, they're all going to be in that playlist. But here we go guys, starting with economic growth in the UK. Annual growth last year in the UK was only 1.1%, a very low figure. A stagnating economy is the UK right now. The last two quarters of 2024, shocking growth figures. 0% quarter 3 2024, 0.1% quarter 4 2024. We narrowly avoided a recession in that sense. Even our growth forecast for 2025, whether you look at the OBR, only 1%, or the Bank of England, only 0.75%. My view is that these are quite optimistic estimates, but it tells you growth is shockingly bad in the UK right now. Yes, a stagnating economy for so many reasons. On the demand side, high interest rates, high levels of taxation, cuts to government spending, very low consumer confidence, very low business confidence. More recently, Trump and his tariffs, this global trade war that could be ignited, all weighing down on the demand side, weighing down on aggregate demand. But even on the supply side, short-run factors like high energy prices, like high food prices, even though we've seen disinflation in both of those areas the last year or so, those prices are still very high, keeping costs high for businesses, constraining supply in that sense. Even long-run supply factors in the UK are so bad, like very poor productivity, very weak investment ever since we voted Brexit, ailing infrastructure, poorly performing public services are all hitting our potential growth rate. Can you believe this? Our potential growth prior to the financial crisis was around 2.5%. Between the financial crisis and COVID, came down to around 1.5%. As we're talking now, many estimates are putting that figure at around 1%. Now, bear in mind what potential growth is. It's the maximum growth an economy can achieve without it being inflationary. So for our potential growth to only be 1%, that is so low, so bad for a large advanced nation like the UK. Given all of that, not surprising that we have a negative output gap, actual output lower than potential output. We measure output gap by looking at actual growth, actual output as a percentage of potential output. Our negative output gap is 0.6%. GDP per capita, income per person, is around £36,000. Wage growth has been quite strong in the last 2 years, has helped to drive that figure up. Our GDP size, the size of our economy, £2.851 trillion. The breakdown of this is quite interesting. 79% of our output is from the services sector, 14% from manufacturing, 6% construction, 1% agriculture. So know that we're a very services dominant economy, financial services, legal services, education services, hospitality related services, yes. But that we're not diverse at all. We don't have balanced growth. That can hold us back as well. Let's move to unemployment, shall we? Unemployment currently stands at 4.4% in the UK, a rising figure. This would be cyclical unemployment. We know that because the natural rate of unemployment in the UK is somewhere between 3.5% to 3.8%. Usually estimates put it in that kind of range. We're above that. That tells you it's cyclical unemployment, corresponding with the stagnating nature of the economy that we've already talked about. But know that all of these employment figures are dubious because the ONS have had massive issues with the labour force survey, getting people to take part in it. Usually, there are around 100,000 people that take part in this survey. More recently, they've struggled to get 10, 15,000 people to take part in it. So whenever you have a tiny sample size like that and you extrapolate the results to reflect the entire economy, there are likely to be massive errors along the way. So take this all with a pinch of salt, but these are the figures at the moment, 4.4%. The employment rate, that is those people of a working age who are in work, is at 75.1%, a lower figure than prior to COVID. And the main reason for that is because of a rise in economic inactivity, which is worrying policymakers massively. The Labour Party have a target. They want the employment rate to be 80%, miles away from that at the moment. So yes, what's happened with inactivity? Well, first, what is it? So economic inactivity is made up of people of a working age who are either not willing to work, not physically able to work, or who are not seeking work. And yes, this figure is higher than it was prior to COVID, mainly driven by a rise in long-term sickness, a rise in mental health related illnesses, stress and anxiety related issues, making people not kind of physically able in their mind to get into work, but also a rise in older people who since COVID have not been willing to come back to the workforce. The latter one there is eased a bit. The cost of living crisis has forced many of those workers back into work. But yes, a rise in long-term sickness, a rise in mental health issues, stress, anxiety issues, keeping people away from work, driving up inactivity. And yes, worrying policymakers so much that in the last year and a half, so many policies have been introduced to try and bring this figure down. Like an increase in real-term spending on health in particular, but also education. We've seen cuts to welfare spending. We've seen cuts to national insurance on employees to try and encourage people back into the workforce. We've seen more support and spending on childcare to ensure that people don't need to take time off work. They can actually get into work and stay in work. But yes, a figure that is quite worrying here. And also a figure that's driven up wage growth. It's meant labour markets the last 2 or so years have been quite tight. Wage bargaining power for workers have been quite high, given that unemployment has stayed quite low, but also high inflation has meant decently high wage bargaining power. And it's all meant that wage growth has been stubbornly high in the UK at 5.9%, higher than inflation, a figure that has actually kept inflation up. So in real terms, this is positive wage growth. We're expecting this figure to come down quite a lot in the coming year. We're expecting the labour market to loosen quite a lot. We're seeing signs of that already with rising unemployment. When I say loosening labour market, that's a labour market whereby hiring is quite low, job vacancies are quite low, a general sign of weak economic conditions, weak output, weak growth, right? That's a labour market we're expecting to see. So wage growth we're expecting to kind of come down, which is good news for inflation, not great news for workers necessarily, but better news on the inflation front. We've already said job vacancies are falling, signs of a loosening labour market. Youth unemployment is rising, another sign of a weak labour market, a loosening labour market. And not hugely surprising that in a tough environment economically with low growth, with rising unemployment, it's youngsters that struggle to access jobs, given that they have a lack of work experience, they have a lack of work skills. So that figure has jumped up by around 2 percentage points in the last year. Quite concerning when you see youth unemployment rising, but not hugely surprising. Also know that consumer confidence is very, very poor at the moment. In fact, it's been very weak ever since the inflation crisis, the cost of living crisis started. Since then, we've seen interest rates jump up. That's not helping with consumer confidence. Higher levels of taxation, low house price growth. More recently, the massive uncertainty caused because of Trump, his tariffs, a potential global trade war has all weighed down on consumer confidence. No real sign that this is going to pick up. All the data backs this up. Retail sales figures have been quite poor. A lot of households cutting back on luxury items in particular. It's not a great position to be in with weak consumer confidence in your economy. So there we go, guys. Unemployment. Let's move now to inflation, shall we? Before we continue, I wanted to mention the importance of my examples for exams pack. Now, having facts and figures like these about the UK economy is great for macro essays, but really what you need is detailed case study examples of everything in the course. That's what examiners expect you to have. And that's exactly what this book offers. So in macro, it's not facts and figures of everything. It's case study knowledge of countries, their macro performance, the policies that they're using. In micro, it's detailed case study examples of industries, of markets, and of government intervention in a variety of different ways. This is the knowledge that you need to back up all the arguments you're using in your micro and your macro essays, which will then score you higher marks in your final exams. So if you're interested in getting this book, it's a great time to get it right now. You can simply get it through my website, EconplusDal.com. But without further delay, guys, let's continue. CPI inflation is currently 2.6%. We are experiencing disinflationary pressure in the UK, but note that prices are still rising and inflation is still beyond the target rate of 2%. But yeah, way lower than what it has been in the recent past. Inflation has been so scary, at its highest point peaking at 11.1% in October 2022, but inflation way higher than target for many, many months. It's good to see it falling back towards the target rate. We are expecting this figure to rise a little bit in the coming months, but generally speaking, we should be seeing more and more disinflationary pressure, especially through the back end of the year. There are lots of reasons why. Generally low demand and a weaker economic climate in the UK helping to quell demand and keep inflation low. We're expecting wage growth, which has been a major driver of inflation over the last year and a half or so, to be calming down with a loosening labour market. But also we're expecting a lot of commodity prices and fuel and energy price inflation to remain quite low, helping to keep this figure quite low. And also bear in mind the uncertainty because of Trump and his tariffs, his global trade war weighing on demand can keep inflation low. But also as countries look to divert trade away from the USA and deal with their massive excess supplies, a lot of those products can end up being sold at low prices in markets like the UK, keeping inflation low. So expecting a more disinflationary outlook in the coming year, even if inflation rises a bit in the next few months. To back that up, we can see core inflation at 3.4%. Okay, what is core inflation? Core inflation is CPI inflation, but without price volatile items in the basket. So take out items like food, like fuel, like gas, electricity, you're left with core inflation. Economists call this the underlying inflation rate, telling you generally what the demand is like for goods and services in the economy and what price pressure is like for those goods and services outside of those price volatile items. The fact that this figure is higher than the CPI tells you that the CPI is being weighed down because of disinflation with energy prices and food prices. This figure is higher core inflation, telling you that there is still underlying demand out there for goods and services. And that's because wage growth is quite high, although we are expecting this figure to come down in the coming year for the reasons I've already talked about. Producer price inflation is very low, only 0.3%. What is this? So producer price inflation is measuring the change in the price of the basket of goods as they've been manufactured once they leave the factory gate. This is also known as factory gate inflation. This is a future indicator of inflation. It's measuring input prices, basically, input price inflation for firms. So if this figure is very high, you expect that to eventually feed through into higher CPI inflation. The fact this figure is very low, again, corresponds with everything that we've said, telling us that energy price inflation has been driven down, food price inflation has been driven down, commodity price inflation more generally is quite low. And we expect that again to weigh down on the CPI going forward. Inflation expectations. Households expect inflation in the coming year to still be quite high at 3.9%. Good figure to know. This drives wage bargaining power and wage growth. So yeah, still relatively high, although a figure that probably will come down given the uncertainty caused because of Trump and his tariffs. And we know wage growth is still stubbornly high at the moment, but expected to come down in the coming year. Let's move to trade. The UK is running a current account deficit of 2.6% of GDP. The UK has always had a current account deficit really for the last 30 years or so. And the last decade, the average of the current account deficit has been around 4% of GDP. So being slightly below that is not hugely surprising given that AD is low, growth is low in the UK, helping to quell demand for imports, but still a persistent current account deficit being run. At the heart of that deficit are structural supply side factors, like extremely poor productivity. Ever since the financial crisis, productivity has been horribly bad in the UK, and very weak investment ever since Brexit. Business investment has been very poor. And both of these factors keep costs of production high for firms, keep export prices high, just make the UK horribly uncompetitive. But also, minimum wage is extremely high in the UK, driven up as of April this year to £12.21 per hour for anyone aged 21 or higher. So a full-time minimum wage worker will now be earning something like 65% of median earnings in the UK. We have one of the highest minimum wages in the world. All of this is keeping us uncompetitive and making it hard for us to export to the rest of the world. The pound exchange rate is weak. You would think this would help with our current account deficit. Weak to the dollar, even though there has been instability in the US recently and the dollar has been driven down, the pound is still, by historical standards, quite weak to the dollar at $1.32 and weak to the euro at €1.16. Prior to the Brexit vote, the pound was significantly stronger than these figures, the pound being much higher to the dollar, much higher to the euro than this. And yeah, you would think this would help, right? A weak pound that makes exports cheaper, imports dearer, can help narrow a current account deficit. Not so much in the UK's case. Given that we lack a major manufacturing base, we know that manufacturing is only 14% of our GDP in this country. So it's hard for us to take advantage of a weak pound in that sense. But also what we tend to export dominantly are non-price sensitive services. So hard to take advantage of cheaper exports from a weak pound. And on the import side, what we tend to import are necessity imports, and we lack domestic substitutes for those. So a weak pound that makes those necessity imports more expensive is not actually good news for our current account position. In terms of how the US and the euro area are doing, these are our major trading partners. A key determinant of export demand for the UK. Both countries are struggling. The euro area is stagnating like we are, and the US economy is slowing down because of Trump and his trade policies. Not great news for UK export demand. Let's move now and talk about government finances. Government finances are in bad shape. Whether you look at the budget deficit or the national debt, COVID ruined both. Prior to COVID, budget deficits would often be around 2% of GDP, maybe less. The national debt was often less than 80% of GDP. As we're talking now, the forecast budget deficit for this fiscal year in the UK is from April to April essentially. So we've finished the 2024-2025 fiscal year, but we're not going to get the official figures for a few weeks still. But the forecast budget deficit is 4.8% of GDP. That's government borrowing of £137 billion in that one fiscal year. Very similar to what it's been over the last couple of years. And yeah, during COVID times, it was massively high, 15% of GDP in the fiscal year 2020 to 2021. Our national debt currently stands at 95.5% of GDP. Again, very, very high. So government finances in a bad way, quite unsustainable level of government finances. The government is flirting with the point at which, they're risking bankruptcy, actually. And that's why contractionary fiscal policy has been used heavily since COVID to improve this state of government finances. Fiscal rules have been tightened as well to make sure that budget deficits and national debt can't get out of hand, and there is some plan to bring those figures down. Bond yields, which reflect the cost of the government of borrowing money, 4.6%. This figure has come down a lot since the Liz Truss quasi-Kwarteng mini budget. This market has calmed down considerably. But yes, contractionary fiscal policy is very much what the government has been doing really since COVID ended. And the main arm they've been using are tax rises, in particular direct tax rises like income tax. We have a progressive income tax system in the UK. We can see that very clearly with these figures. So the first £12,570 of income that someone earns is tax-free. That's the personal income tax-free allowance. From £12,570 to £50,270, that income is taxed at 20%. Any income from £50,270 all the way to £125,140 is taxed at 40%, and any income earned above £125,140 is taxed at 45%. But yes, income tax is increased in two ways. First of all, that higher rate of 45% used to apply only on income above £150,000. Now it applies on income just over £125,000. So that is a tax rise on the very rich right there. But also these tax bands have been frozen all the way to April 2028. Now, how is that a tax rise? Well, every year people's pay tends to go up, right? Hopefully in line with inflation, in which case you could understand people aren't actually better off. They're just getting a pay rise in line with inflation. But that pay rise can now drag more workers into higher income tax bands where they pay higher rates of income tax, which can actually make them worse off. This is the phenomenon of fiscal drag. It's terrible news for workers. This one policy is forecast to drag millions more people into either paying income tax or paying higher rates of income tax. But it's great news for the government, who can earn so much more revenue from this. Just this one policy is forecast to earn the government an extra £45 billion a year by 2028. It's the equivalent of a 7 percentage point rise in income tax. Massive tax rise there. The government is trying to offset some of that by reducing national insurance. In the last 2 or so years, national insurance on employees has come down. Now, bear in mind what national insurance is. It's another income tax on top of traditional income tax. It's basically a tax on having a job. Employees have to pay it, but also employers have to pay it. So on employees, the rate has come down twice. So initially from 12 to 10%, and then from 10% to 8%, initially as a demand side measure to counter some of the impacts of higher income tax, more recently as a supply side measure to try and reduce economic inactivity, to try and get those guys back into the workforce, to start looking for work at least. But as of the last budget, national insurance on employers has gone up to try and bring in more revenue to reduce the amount of government borrowing to improve the state of government finances. So even though we've seen cuts in national insurance for employees, overall tax rises have been the dominant avenue of contractionary fiscal policy. Even corporation tax increased last April from 19% to 25%. The tax burden in the UK is the highest it's been since the late 1940s, and that could even rise further in the coming years. VAT is at 20%, and our Gini coefficient, an indicator of income inequality, 0.357. Good figure to know, and also good to know this figure has increased over the last few years. Not surprising when the government's been cutting spending on benefits. They've been cutting spending in real terms recently on health and education. We've seen higher taxation, in particular hurting those on lowest incomes the most. Not surprising, therefore, that income inequality has risen recently. Good to know that. Let's finish this video, shall we, by looking at interest rates. The Bank of England base rate is 4.5%, a figure much higher than it was in December 2021, where interest rates were as low as 0.1%. Since then, the Bank of England raised interest rates substantially and at a very high pace to tame out of control higher than target inflation. Interest rates went all the way up to 5.25%. But in the last 8 months, they've been cut 3 times to now 4.5% as an expansionary monetary policy to try and boost AD, increase growth, lower unemployment, given the stagnation that we're in. The big debate at the moment is whether the Bank of England need to be more aggressive with their interest rate cuts, cut rates even further. And I would agree with that general idea. Now, we know that this year should be even more disinflationary. We're expecting inflation to come down by the back end of the year. It looks like the inflation fight is no longer the most important macro objective, the most important priority. Boosting growth, lowering unemployment is far more significant, especially given the impact of Trump and his trade policies, how that can dampen growth further and even be even more disinflationary in the UK. So expect interest rates to be cut as soon as next month, and a lot more as the year goes on as well. Are those lower rates being passed on to consumers and businesses? Yes, the average lending rate proves that, very similar to the base rate. Banks are generally speaking quite willing to lend, but we know consumer confidence is very weak. We've covered that earlier, limiting the effectiveness of expansionary monetary policy in boosting AD to its desired level, but also business confidence is very, very, very low. It's been low ever since the Brexit vote. More recently, very poor macro performance, higher taxation on businesses, and the impact of Trump and his trade policies have absolutely hammered business sentiment. The savings ratio is quite high for UK standards. The savings ratio is the proportion of disposable income that is saved and not spent. Prior to COVID, that figure would always hover between 4 and 5%, but it's 12% at the moment. Not hugely surprising. We're in a cost of living crisis. Interest rates are quite high. Taxation on households has been driven up. We've also seen consumer confidence been smashed recently. All reasons why savings have increased. So not hugely surprising, but high for UK standards. And lastly, quantitative easing. The total amount of money that the Bank of England has pumped into the UK economy since the invention of this policy is £895 billion. A lot of that was during the financial crisis years. Some of it was after the Brexit vote. A lot of it was during COVID years. £450 billion of new money was pumped into the UK economy during COVID years via quantitative easing. No wonder we saw high inflation in the aftermath of COVID, right? So there you have it, guys. All the key stats and information you need to know about the UK economy. Use these in your macro essays and see those marks and those grades increase. Make sure you share this video to anyone that's going to find it useful or to anyone that's going to find it interesting, and make sure you're watching all the videos in my revision for 2025 exams playlist. God, there are so many in there which are great and so many more to come. Watch them all and make sure you're revising at the highest level so we can smash these exams together. Thank you so much for watching this one, guys. Can't wait to see you in future videos. Thanks for watching.